Your retirement account has a ticking time bomb in it, most of you, a good number of you, and the mainstream media is not going to cover it. In this episode, we're going to connect the dots, follow the money. I'm going to explain everything, and we're going to talk about what you can do about it.
You already know the deal. This is for information and entertainment purposes only. This is not investment advice. I'm not a financial advisor. I am not your financial advisor. All investment incurs a risk, a loss of your money. You could lose it. Don't you ever forget that. This is just all my opinion. Take it for what it's worth. So with that being said, it's a really good show. You're going to learn some things. Enjoy.
So I got some semi-bad news and good news. This affects almost every single one of our listeners, and the mainstream media is not going to cover it. Your retirement account has a ticking time bomb in it. Tick, tick, tick. Almost all of you, most of you, a good number of you, has a ticking time bomb in it. And in this episode, we're going to connect the dots, follow the money. I'm going to explain everything, and we're going to talk about what you can do about it. Okay, so if you've been paying attention to the show, one of the themes that we've been talking about is I've been slow walking you through this idea around private credit and how there is a huge crisis happening within private credit. I hope you've been following along with it. There have been redemption limits. Just to give you guys a little bit of history, private credit crisis. People are redeeming. The loans in these private credit funds are underperforming. Hey, we have some liquidity issues. Is it contained to just these rich people and their funds? And so they've been saying, no, it is 100% contained. It's not going to affect everyone. And they've been dealing with it. We're going to talk about, because since the last time we talked about it, a whole lot of stuff has happened since then.
Right.
So I've been showing you how, even though they say it's contained, it's going to affect every single American, and showing you the breadcrumbs between private credit all the way to insurance. Okay. So you remember that.
Yeah.
Right? Private credit. So what I want you to think about, especially for the purpose of this episode, I want to give you this analogy about how the issues with private credit can affect any sector of the economy. What I want you to think about in terms of the economy is even the global economy. I want you to think about a big circle, right? Not a pie, just a circle. Any sector in the economy is a point on this circle, okay? This continuous loop. So you got stocks, you've got private equity, you've got real estate, you've got everyday people and their normal money and their jobs, you've got sovereign wealth funds, all these different things. On this circle, you got a couple boulders. You got a couple boulders. It's some green boulders, and then there are some red boulders. The first boulder that is on this circle is risk. Most people think that they can eliminate risk, especially on a macroeconomic scale, that risk can be eliminated.
Okay, define boulders real quick. When you use the term boulders, because I thought when you said boulders, I'm thinking of like larger players, but that's not what you're saying.
No, a boulder is a rock, a big giant rock that
so
can't go away.
Just an obstacle, something. No?
Nope, I want you to think about rock.
Okay.
Just let me finish the analogy.
Okay, all right.
Rock, a big giant rock on this circle. So a red boulder is risk. So if there is a very risky industry and people are doing business in that industry, you can't eliminate the risk. You can only shift the boulder to another stop on the circle. Okay? Risk is not eliminated, it is migrated. The only way that it's eliminated is if you just stop doing business in that area altogether. All right?
Makes sense.
So like, I want you to think about like, if you have a business, you start a business and it's a risky business where it's like, hey, you run a mouse walking business. You walk people's mice and you've invested your money in it.
Yeah, I just got a hamster. So
You walking you're walking people's hamsters. And you're doing this business and you're stressed and this is a risky business. The only way to eliminate the risk is to close the doors. But otherwise, while you are still doing the business, I don't know how difficult it would be, but you can move the risk to someone else. And that's typically what happens in the macro economy because it's difficult to just close the doors of a particular business. Private credit can't close those doors.
Right.
Okay? So you can move it to another area on the circle.
So that's one boulder.
It's one boulder. That's a red boulder.
Okay.
Okay? I'm going to go to a green boulder. Green boulder is liquidity. Okay? Liquidity is a green boulder. We've had this conversation before in this show, whereas most people have the wrong interpretation of liquidity. All right? Liquidity is cash or the ability to turn something into cash. So something that is very liquid is something that can be turned into cash very quickly. So for example, liquid assets, cash, money market accounts, treasuries, these things can turn into, somebody's going to buy it immediately. Mm-hmm. Something that's illiquid, real estate, private equity fund holdings, hedge fund holdings, or shares of a hedge fund, I should say, shares of a private equity fund, private credit loans, illiquid. Who's going to be in the market to buy a tech company's debt? Very few people.
Yeah.
Okay? So these things are illiquid. Illiquidity is a red boulder. Okay? When a market or an area of the economy has illiquidity, you can't make it go away. You can just move it somewhere else. All right? Mm-hmm. So private credit has this issue, and I promise y'all, just sit tight. I'm going to tie this to your retirement in just a minute. Private credit has this issue where it's risky and it's illiquid. That's a red boulder. Okay, so we got liquidity, a green boulder, and illiquidity, a red boulder. Typically, they're traveling in a kind of quantum entanglement type of way. Mm-hmm. All right. Private credit is illiquid, and so it's risky and illiquid right now.
Right.
A little bit too illiquid and too risky than what they underwrote. Right. So this is why we've got these big redemptions, the redemption limits, lawsuits. They're marking down NAVs of the loans inside of the private credit. I'll talk about that in a minute. So this is just chaotic over there. They are suing each other. Everybody's pissed. People not getting their money like they want to get their money. Everybody's pissed. Okay. It is a huge industry. So what they're trying to figure out is how can we shift this risk and this illiquidity to another sector. And so what I told you when I painted the whole picture from private credit to insurance companies is that there are only a few industries that can absorb the risk and the illiquidity of private credit. The number one is insurance. And then I named some others. Another one is sovereign wealth funds. This is how we ended up doing the sovereign wealth fund episode. Mm-hmm. Because I was like, if y'all want me to talk about sovereign wealth funds, because sovereign wealth funds, we discovered, makes up 13% of the world's GDP, and no one talks about it. Mm-hmm. And Norway owns 1 to 2% of all equities in the whole entire world. Some of the things like up to 1.3% or something like that. Yeah. That's crazy. All right. Or publicly traded equities, I should say, in the whole entire world. That's insane. That's how powerful sovereign wealth funds is. Cool. Then I had a couple of other footnotes of some other industries that could do it. Collateralized loan obligations. Y'all let me know if y'all want to talk about that in just a minute, because that was a big reason of the 2008 crash. And then pensions. Okay.
I'm glad you said that, but keep going.
Yes. And so I said it in that episode, pensions. And so I was like, we're not going to talk about any of that, because those industries are, the reason why insurance is so perfect is because it's large and the maturity dates are long enough to match up with some of these loans, mm-hmm. some of the obligations in private credit. Okay. So you got a maturity date match.
Right. So speaking of that, when you say maturity date match, just talking to my friend, he just closed on his house. And he was telling me the house is valued somewhere around, I think he got it $654. He was telling me he had mortgage insurance. Mm-hmm. And so I was just like, mortgage, because I've never heard of mortgage insurance.
You about to go down a whole different...
No, just insurance in general. Uh-huh. As far as how you were saying a couple episodes ago, They got it down to a science. And so he was just like, yeah, my mortgage insurance goes, like if something were to happen to me, God forbid, they'll pay off, the rest of the house of what I owe or whatnot. And so I make the statement to him immediately after that. I'm just like, that's just crazy, because I never understand then if that, in that case, how does insurance, how are they going to win in the long run, right? And he was like, well, you got to think about it. Like, the goal is for the person to stay into the house until they pay it off. Like,
that's how all insurance works, is that you overpay, they indemnify you. You overpay the risk, the collective risk of everybody in that insurance pool of the thing happening. In addition, they take the premiums and they invest it into something that's going to give them a better return, so they can make money on the spread.
Right. And so they've been using those premiums differently in the past. And so now
yes, they've been doing private credit and private equity.
Right.
And so they've gotten greedy. Okay. We went over all this already. I'm not going to go in.
No, not going back over. I'm saying going back into what you're saying, because it used to be pensions.
Hold on. You're talking about two different things. Okay. Private credit, there's a couple of key industries that are perfect for absorbing this. Insurance, sovereign wealth funds, collateralized loan obligations, pensions, and then there was another one that we haven't talked about yet. I can't remember it off the top of my head. Irrelevant right now. We talked about insurance. We went in a deep dive about why insurance is perfect. Then we talked about sovereign wealth funds. Not ideal, but could be an option. I did not think we were going to talk about pensions until news dropped the other day. Big time news dropped the other day that I think everybody should have paid attention to. I'm thinking in my mind like, The news was they did some research and found out that CITs, which are collective investment trusts, could potentially make up 40% of 401k investments. Okay? Let me tell you why this is the ticking time bomb. Pensions, and then we got 401ks. Now, for those of you who are not familiar with retirement, let me give you a little bit of game. You have retirement accounts, right? Retirement accounts are legal, specific types of accounts that legally they have to behave a certain way. You have a contribution. You have rules around contribution, and you have rules around withdrawal, when you can start to withdraw money. Taxes are important. There are probably about 30 different types of retirement accounts, okay? They're subdivided into a couple different categories. The first one is defined benefit category. Pensions are defined benefit. They basically say you work at a job and they say, hey, you have a pension. Guess what? You're going to get $4,000 a month after you retire till you die. The benefit is defined. And then another type of top level category, because then you got subcategories, is defined contribution. Defined contribution, the job says, we are not going to guarantee that you're going to get a certain amount of money. We will guarantee that we will potentially match what you put in. So what they did was, remember, this is another way that they moved risk. They had investment risk before with pensions, right? Or not before, in pensions, because there is some timeline history here. There is an investment risk. If you work at ABC Corporation and they're giving everybody pensions, the company is taking on the risk of this pension performing so that it can pay you what we promised you.
Right.
Okay? Then, and I think it was 1978, so most retirement plans were pensions, or I don't want to say most, but defined benefits, okay? Then in 1978, companies was like, we don't want this risk anymore. We want to pass the risk off to you. Okay? In addition, we want you to contribute. So, here's what a 401k is. This is a defined contribution. You contribute and we'll match, and Here are a list of investments, because the company also decides what investments you can do. Because retirement accounts can actually, just think about the overall broad, retirement accounts can take a lot of types of investments, more than what your job typically offers. You can theoretically, not theoretically, but legally, in a retirement account, you can invest in gold, you can invest in livestock, you can invest in commodities, you can invest in Bitcoin, you can invest in real estate. I theoretically, if you're doing a real estate deal, that's just not in retirement, I can use my retirement through a different type of account, a self-directed IRA, through a custodian, and invest in your deal. You can get so funky.
I remember you was telling me something like that off camera.
Yes, when we were talking about retirement.
Yeah.
Hold on, let's stay here for just a minute, okay? Hey, real quick. Speaking of self-directed IRAs, one thing a lot of people still don't realize is you can actually hold assets like crypto inside certain retirement accounts. Platforms like iTrust Capital, they let you buy and sell crypto through a self-directed IRA with potential tax savings. And if you use my link down below that I'm giving to you, they're going to put $100 in your account to get you started. So if you've been looking into alternative ways to diversify your retirement assets, because of some of the stuff that we're talking about on this episode, it's at least worth researching. So go to the link down below so you can get $100, and I'm excited for you. Now back to the discussion. I can use my retirement through a different type of account, a self-directed IRA, through a custodian, and invest in your deal. You can get so funky.
I remember you was telling me something like that off camera.
Yes, when we were talking about retirement.
Yeah.
Hold on, let's stay here for just a minute, okay? But the job says you can invest in this. All right? And so most jobs make you select from a menu, right? Through your 401k. When you select from this menu, most people think that they have mutual funds and ETFs in the menu. You've made this selection. What has increasingly gotten popular, now here's the thing about ETFs and mutual funds, they're publicly traded. So what's in them is public. You can get the ticker, you go and you look and you're like, oh, I got this in there, I got that in there, I got, you know what's going on. CITs are like mutual funds, but they are not publicly traded. Okay, they are bank instruments, and there is opacity. They do not have to report or be public about everything that's in it. So typically what the typical structure, they're not all structured like this. The typical structure with CITs, so your job has a bunch of CITs in it, or as a menu, and you probably picked a CIT. Didn't know you were picking a CIT, didn't understand it, I shouldn't say that, didn't understand it. And within the CIT thing is a trust. That's the whole point of a trust, is that there is a layer of secrecy to what you can do in the trust. That's why people do trusts.
So the CIT essentially, if this were
they're bank products. There's also, I want to say this before you go into that. They are regulated by ERISA and bank regulations.
Okay.
Not the SEC. Okay, so go ahead. If this were a house.
So I like to use analogies because that's how my brain works, analogies. So if we're talking about a house and we're talking about the infrastructure and we're talking about the foundation and layout, stuff like that. So CIT, would that essentially be like what, the plumbing system?
No, the CIT is the darn house. The street and the houses on the street is the menu that your company says, hey, you got Main Street. Pick 123 Main Street, 124 Main Street, 125 Main Street. Each address is a CIT. Inside the house, now some of these houses is glass houses. Those are your ETFs and your mutual funds. You look, oh, okay, you can see from across the street. Oh, they got that over there. That's cool. The CIT house is the Men in Black building with no windows. It's a Scientology building.
Yeah.
You have no Scientology building. We have no windows and no doors. I'm dead serious. They don't be having no doorknobs. You go up to the building, there's no doorknob.
And you don't know what's going on behind them walls.
You don't know what's going on, and they like it like that. So here's
the
the
CIT
thing.
house is the Area 51. It's something going down in there, but nobody knows.
So it's not completely 100% opaque. You got to dig, but you're not going to know everything.
Mm-hmm.
Sometimes they will tell you that the typical structure right now is what's called maturity date, target date funds. You've seen these where it's like, if you know you're going to retire in 2035, there's a 2035 fund, and everything that's in this 2035 fund, this could be a mutual fund. Everything that's in this 2035 fund targets to have maturity dates that match up with your retirement. In CITs, the current structure is inside CITs. CITs will have these target maturity date funds in them. Okay? But that don't mean that it can't put some other stuff in it.
Mm-hmm.
So I did a short about this, about CITs, and I realized that some people misunderstood what I was saying because they thought, and I realized I may have said it in a way that allowed people to misunderstand that you just wake up and you got CITs and you didn't put them in there. Mm-hmm. That's not what it is. You choose the CITs and then you have no control over what's happening in the CIT.
Yeah.
That's how it is. It's not like you just wake up and you're like, how did this get here? No. You had the CIT, you made the decision. And in the CIT is opacity, and then guess what they can buy? Guess what they can buy?
Oh, you actually want me to guess?
I want you to guess.
Guess what they can buy.
Guess what they can buy.
I don't know. I mean, I feel like it's not much that they can't buy because
Facts. But we're talking about for the purpose of this, the ticking time bomb and all of this. What they can buy is private credit. They can hold private credit funds. Remember, I told y'all, we need to figure out where to offload this illiquidity and this risk. There are a couple of industries that are perfect for it. Insurance, sovereign wealth funds, pensions. And the reason why I said pensions and not 401ks or retirement as a whole is because the employer has so much control over the money. Mm-hmm. This never occurred to me that they were sneakily putting CITs into 401, giving people this menu to choose from into 401ks. Now, keep in mind, the person is making the decision. The pension, I'm thinking pensions because the company's making the decision, and they have a fund manager that's managing all of it. Now, to go even more in depth, we have a newsletter where I break down structurally interesting things that really move the market. I give you my frameworks for how I think specifically about business, because you need to understand business to understand this stuff. Also, too, y'all know I have partners for our private equity fund, and they contribute to the newsletter too. They know their stuff with apartment investing. Noelle Parnell and Arthur Lyons. Get on the newsletter. The link will be down below. It is 100% free. There are a couple of industries that are perfect for it. Insurance, sovereign wealth funds, pensions. And the reason why I said pensions and not 401ks or retirement as a whole is because the employer has so much control over the money. Mm-hmm. This never occurred to me that they were sneakily putting CITs into 401, giving people this menu to choose from into 401ks. Now, keep in mind, the person is making the decision. The pension, I'm thinking pensions because the company's making the decision, and they have a fund manager that's managing all of it.
Okay, so let me follow you real quick, because as far as I know, and as far as I know about the pensions, like you said, company took on all the risk with a pension, right? And then 401ks, company split the risk down. Like, okay, you take.
They're not splitting, they pass it all. They pass the risk on to you completely.
Well, when I say split it, because they hit you with that match, no?
They're contributing. I don't care what you do with the money. I'm paying. I'm giving it to you. I'm matching. There's no risk in that. I already know what there's no risk.
Okay. So the employer in that case assumes all the risk in the 401k.
No, the employee.
The employee is what I meant.
Yes.
Yeah, the employee in that case assumes all the risk in the 401k.
Mm-hmm.
And so you're saying inside the 401k, they're sneaking in these CITs.
They're not sneaking it in. You chose it.
Okay. Well,
but you don't know what's in the CITs because it's opaque. because it's not publicly traded. It's not regulated by the SEC. These are bank products. And so they have to figure out who's going to buy these illiquid loans from private credit funds, and who's going to hold these illiquid shares because they're all getting redemptions. Who's going to hold it? These institutional investors, they're liquidating like nobody's business.
All right, so
Who's going to do it?
Go back to these boulders. So you're saying this red risky boulder right here. This is what you're saying. This red risky boulder that was in private credit. Now they're passing this boulder along.
Hold on. The boulder is private credit. That's not going to go anywhere. The private credit risk boulder is being passed from institutions
That's the
and
boulder I was talking
institutional
about, yeah.
and accredited investors on. So I want to say the risk is leaving private credit. It's not that. It's just that institutions and institutional investors held the private credit risk. And so we're just moving the private credit risk as well as these illiquid loans into your retirement account.
Into a CIT.
I'm not saying that it's definitely happening, because as of right now, there is no way to know this number. The best estimate that I have seen about CITs and how much they hold of private credit is less than 1%. But we don't know.
I got you. You're saying it's only so many places that risk can
I literally gave you all a list of places that it could go.
Yeah.
But we don't know because of the opacity. Now I want to give you a little bit more history information about this. The New York Fed published a report last week. I do believe it was last week. It could have been a week before, but the New York Fed published a report that said that non-bank funding institutions, NBFIs, hurt banks more than they realize. They did a study. Okay, what are NBFIs? NBFIs are non-bank funding institutions, hedge funds, private credit, private equity funds, insurance companies, pension funds, structured credit vehicles, collateralized mortgage obligation structures. So anything that's non-bank funding instrument, okay? I did not know this. I learned this last week as well, that 50% of the world's assets are NBFIs. NBFIs, this whole world exploded after 2008 because the banks had to kind of look at the risk that they were taking on, and then all of these other alternative solutions started popping up to provide loans that the banks couldn't do. All right. So the main point of the report is that the banks hold NBFIs on their balance sheet. And so most of these NBFIs, especially with private credit, they've been saying, hey, it's contained, it has not spread to banks. About a month ago, we had the bank earnings season. Right. And that was the big message, that private credit hasn't affected us. But the Fed just posted a report the other day that said, no, it's affecting banks, because the banks that hold NBFIs on their balance sheet, they're not performing well. And we are seeing the stress cracks.
So essentially, they have unrealized losses.
I'm not saying it.
No.
Stress cracks. I want to use the words that they say.
Okay, you might not say it, but let me ask in my head would it be safe to say, or would it be safe to...
No. Go ahead, I want to hear your question.
Would it be safe to street assume, right? Like just hearing that banks are floating unrealized losses through these
NBFIs? Potentially. Because
on their balance sheet.
I want to read something
not
off
accounted
to you.
for.
Yes, because I want to read something off to you. Here we go. So what I did was, because we've been talking so much about private credit, from the last time we talked about it, so much stuff has changed. And I printed off a list of things that have changed. Remember, private credit funds are NBFIs. Okay? So you pick up what I'm putting down. You want me to say a strong statement, and I'm not going to say it
Yeah.
because the whole point of this show is to get you to think for yourself. Okay? I'm just showing you the breadcrumbs. Do you want to eat it? Up to you. I don't care. No, I'm joking. I do actually care. That's why I do this show.
Okay, DT.
You already know. We got the joke. Is this thing on? I don't care about you people. I actually believe. I don't want to say believe it or not.
They know you care. They know
really
you care.
do care.
Yeah, they say it in the comments every week. They know you care.
I really genuinely care.
You pour out a lot.
But what I don't care about is some people are going to want to stay plugged into the matrix, and I cannot help them. I'm Morpheus when it comes to that. If you want to stay in the matrix,
Silence.
I don't care. I can't help you. I can't. I don't know. I could probably psychoanalyze myself and think about like, forgive them, Father, for they know not what they do. That's how I feel. Because it's not I don't care, but it's like I can't help you.
Not pulling out John. That's in John, ain't it? Ain't that in John? That's in Matthew. That's in a lot of
Jesus
different places.
said. Yes.
Yeah, it's in John. It's in Matthew.
That was one of his last 7 statements that he said on the cross. Forgive them, Father, for they know not what they do. There's some people that, first of all, our channel has been going crazy.
Crazy. Shout out to y'all.
I love y'all so much.
Shout out to every comment. Shout out to every like. Every
y'all,
subscriber.
I really can sit here and cry because I love this, and y'all are allowing me to do what I love. I really want to cry.
Y'all put me to work with the books. I had to walk in here and do something totally new this morning. Something totally different.
Y'all been ordering the books like crazy.
Like crazy.
My Christian business book, The AntiHustle. There is a very powerful, on page 125, on page 129, there is a very powerful manifestation technique based in biblical principles. It starts on like page 125 because I have to give you some context for it. And it takes you through a year-long journey to getting to your purpose. And y'all already know I'm 100% in my purpose right now. And guess what? I use this technique. I've been doing this technique for almost 10 years, and I had to redo it. I run my own scripts. I reread my book that I wrote in 2017, and then immediately after, here we are. I gained. We almost at 50,000. I gained from 15 to 50,000 in less than 2 months. Okay, you do the math. All right. So let's give you an update from private credit.
Okay.
All right. The New York Fed warned that stress, this is the thing I'm telling y'all about right now. The New York Fed warned that stress spread from non-bank funding institutions and BFIs into banks, spotlighting shadow banking private credit transmission risk. BlackRock Private Credit Fund cut NAV 5% after troubled loan markdowns and weaker returns. JP Morgan reportedly marked down some private credit linked loans, tightening financing to the sector. Blue Owl, they out here getting buck. Blue Owl reducing software exposure due to AI disruption fears impacting borrowers. Blue Owl sued over allegedly inflating fund values and charging excessive fees. Blue Owl facing record short interest as investors question private credit liquidity and valuations. BlackRock reportedly limited withdrawals from a private credit fund. KKR, large retail facing private credit fund, took a $560 million loss as default climbed above 8%. Defaults 8%? Okay. Apollo exploring sale of $3 billion private credit fund as defaults and NAV discounts widen. Private credit stocks broadly selling off. Growing concerns around private credit transparency, redemption pressure, and valuation smoothing. So this is why this is going to be a real quick aside. Valuation smoothing. What I don't want you to equate risk with volatility.
Okay.
They're not the same. So we already know I'm Nicole Volatility. We're in a volatile market. Ta-da. Some of y'all met me as saying Nicole Volatility, and here we are. It's volatile because I called it, all the things, right? The reason I don't want you to equate it is because things can be volatile, but depending on how often something is marked or valued can change how the risk is perceived. All right. So you got stocks out there that's valued every moment of the day. And so it can look risky if something's up and down and up and down and up and down and up and down every moment of the day. But these funds, because they are marked to model and could be marked on multiple increments, so they're not marked to market, they're marked to model. They come up with a valuation model and say, hey, this is what the value is. And it's usually the fund managers that decide what the value is. So they own asset and they decide what the value is. And we're not going to market until whatever we decide. Hey, this is marked at 100% on January 1. We're only going to change or update the valuation once a month. So it looks like for a whole month, while your stock is going bing, 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 looks like for a whole month is at 100. By February, could be at 95. So it looks less risky because it's staying at a valuation for a certain period of time.
And they have the authority to do so because of the lack of
opacity, transparency,
lack of regulation,
or not lack of, because of opacity, because of lack of transparency, not lack of regulation. It is regulated. It is more loosely regulated. It is regulated, but it's regulated by ERISA. But there's something also called, I think, OCC, or that's what regulates banks as well. But hold on. My whole point that I'm making here is private credit is a risky little thing. And your 401k can easily be absorbed. It can absorb it. 40% of 401ks have CITs in them. And you don't even fully understand what it is. Are CITs bad? No. Let's be very, very clear. I don't want you to be like, I got CITs. This is horrible. They're trying to take money from me. No. But what I do want you to understand is this. Remember I talked about the boulder. Most of you are focused on, you're thinking about risk. That's not the most important boulder in this economy. In the debt economy that we have, that's not the most important boulder. The most important boulder is the illiquidity boulder. In the debt economy, in terms of, we look at it from a macro perspective, the banks are at the top of the food chain. First of all, I think insurance and banks, they run the world. But we're not going to talk about insurance right now because the insurance is like moving in the shadows. We don't want y'all to know we here, but we see everything. But the banks, they out front, like, yeah, we run everything. They're the first, in terms of when we have a recession or depression, it's always marked by what happens to the bank. If it affects the bank, then it's a major economic thing. They're the first line of defense and the last line of defense. Nothing is real until it affects banks.
Right.
Globally, okay? So, banks cannot absorb illiquidity. They cannot absorb illiquidity. Now, this is another thing I want you to think about with illiquidity. I want you to change your mind around how you view liquidity. I was about to go down this road at the beginning of the episode. I don't want you to think about liquidity as just a physical thing, cash, money, cash. I want you to think about liquidity in terms of time.
That's exactly what I was just thinking. When you use the word absorb, of course, because I trade and things like that. So when I'm looking at a chart and what they call dark pools. Dark pools is when large institutions place orders on books that you can't see live. So you have live order books, and then you have dark pool order books, where an institution will try to offload maybe 2 million shares, right? But you can't offload 2 million shares at one time or it'll crash the market. So what you do is you put this 2 million share order into a dark pool where a large institute
can buy it,
and then they can offload it like that.
Okay, I like that, but I like that. You day traders, it's a whole game. That's exactly what y'all playing video games. Y'all playing video games. I ain't mad at you.
But it
Do your
sounds like
thing.
the same in essence.
But hold on, it's not, because it does the way when they do it that way, they are protecting liquidity, right?
Oh wait, but I know what I was about to say because you were using the word absorb the liquidity.
What I said was time is what made you go.
Was
in that way.
time. Those institutions that take those shares that take on that whole 2 million, because they'll exit the position, and then the institution that picked up the absorption has the time to sit there and deviate each share. Like they have that time.
They can do it over time.
They can do it over time, and so, like you said, it might look like people just buying, and it should be going up, but it's just hitting the wall the whole time. It ain't going nowhere.
That makes sense. Okay. Hold that for a minute. Let me give this analogy. What I want you to think about with liquidity is time. Most of you are stressed because you want more money. You have a dollar amount. I just need $10,000. I need this amount of money. Here's the thing. And then you're walking away, not hitting that goal, and feeling like scarcity. And the reality is, this idea of scarcity is an illusion, because you're not asking the right question. You are not asking the Father the right question. You're asking for, I need $10,000. Each and every one of you are money magnets. Each and every one of you are money magnets. You can easily, you are attracting that $10,000. You are attracting that $100,000. You are attracting that $1 million. You are. You will get it. Ask and ye shall receive. But if you ask me for $10,000 and I give it to you over the course of a year, can't be mad. What you need to do is start thinking about, I need this money quicker. Because when you start keep looking at your bank account and saying, hey, it's not there, you're introducing this unnecessary idea of scarcity. And it's not scarcity, it's just coming to you slower. And what you need is faster money. That is what liquidity is. Because when you have an idea, when you take on the frequency of scarcity, it messes you up in a number of ways. Because also you are not letting currency current, right? You got to take the money in, you got to pay. Take it in, pay. When you got scarcity, I'll take it in, 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 hold it, hold it, hold it, hold it.
A preacher just then. You're not letting what? Say that one more time.
You're not letting currency current.
Deep.
So you have a scarcity mindset because the money's not coming fast enough. So you take it in, you hold. And then that bill come in and you're like, What I want you to get to the place of is Jesus. When they ask Jesus, hey Jesus, listen, we doing miracles. We having a good old time. We balling, we get what we want. Caesar coming for us, taxes. We don't want to pay taxes. It's okay not to pay taxes. What did Jesus say?
Pay them taxes. That's what he said.
Pay Caesar his money.
Pay them taxes.
Pay his money. Give him his money. Who on that coin? Caesar. Give him his money.
Give him what's owed to him.
Give him what's owed to him.
His face is on the coin.
So this is what I need you to do. Stop living in a scarcity mindset and holding on to Caesar's money.
That's also another principle though of that goes back to, we already said that episodes ago though about the talents. It's the principles. You don't bury your talents.
Right. So let's come back to liquidity, because that's what Jesus was teaching in Pay Caesar's Money. He was teaching you liquidity. Mm-hmm. Especially in this debt environment. The government does not want your assets. These corporations, they don't want your assets. They're cool with you having your assets. What they want is your liquidity, which is your ability to make money in a quick amount of time. And as long as they can get you to believe in this, the illusion of scarcity, they'll take your liquidity every time. Because they're putting out fear messages. Just what did your boy DT say the other day? They said, Mr. Trump, how do you feel about Americans' income? How do you feel about Americans' income and with the war going on? She asked it in a nice way too.
What do you think the war is going to do to the Americans' financial situation?
He said, "Is this thing on? I don't care about you. Have a good day, good night." So for those of you who don't know, we have a little joke where I basically said that in the past, the government acted like we can have a conversation as to whether they care about us or not. I saw a clip, I just reposted in my stories, of John McCain being so like honorable when they was talking about Obama. He did a town hall when he was running, and they was like, "I'm scared of Obama. He's a horrible person." And he checked two people on the same thing, like, he's not a horrible person. He's actually a good person. I'm just better for the job. He's a good dude. Yo, come on, John McCain. That just made me, I want to go back in time and like you.
I want to go back in time and like you.
Because I was too young. I didn't understand. I didn't understand this version of these people that's out right now. I didn't know these people existed. That they're going to get on the mic and be like, "I don't care about you. Thanks. Have a great day." So that's been our joke, that these
they gotta go back. Yeah.
Yes, you gotta go back.
The
Yeah, you
only
gotta go
thing
back.
that
I placed the clip
matters
here.
when I'm talking about Iran, they can't have a nuclear weapon. I don't think about American financial situation. I don't think about anybody. I think about one thing. We cannot let Iran have a nuclear weapon. That's all.
Donald Trump said, "I don't think about the American people and their finances." He literally said this. Whatever. That's neither here nor there. Okay, anyways, your liquidity. They don't care about, y'all think they're after my money. They're not. They're after your liquidity. They will, and by they, I don't necessarily just mean the government. I'm talking about the powers that be, the ones who influence this matrix. They will. It's great when you are in scarcity mindset, because currency is not currenting, and when currency is not currenting, that allows them to pass illiquidity on to you. Okay? So that's one of their strategies of passing illiquidity on to you. So what I want you to reprioritize in terms of this conversation about liquidity, what I want you to reprioritize. I know a lot of you wake up and you're like, "I want to build wealth. I want to build wealth." And some of you are even like, "I want to increase my income," or "I want to make more money." Want to build wealth. I want more cash. That's typically the two things that you're saying. I'm after this cash. I'm after more money. No. What I need you to be after is more liquidity. I'll definitely build wealth. For sure, for sure. And here's the thing about building wealth. This is the trick. Y'all remember the scripture says, God says, "It is I who have given you the power to get wealth." So you don't have to worry about getting wealth. You don't have to chase wealth. But what you do have to chase and be intentional about is liquidity, because when you have liquidity, it's easy to build wealth. That's just a fruit of liquidity. It's just a fruit of liquidity. So as you are making money, the more money you make, the more you can pay. Guess what? The more you can to the side. To the side. And look, ooh. I want you to prioritize liquidity. We're going to talk about how to prioritize liquidity in a minute, but I want you to understand the difference, and it will change how you do business. It will change how you prioritize. One of the things I just decided I'm going to make content for, a lot of you y'all are here because y'all been studying this wealth game for a long time. Most of you are not new. It takes you a minute to understand that you got to understand the macro part, right? So most of you are not new. Most of you have been at this for a while. You won, you lost, you won, you lost. And half of you, I would guess, you making it back. Because if I had to say the things that you were supposed to learn that you haven't picked up yet, is this. You're chasing the wrong thing. You're chasing wealth. That is the secondary. The first is liquidity. How can we automate your liquidity and protect your liquidity? For me, this is why I like private markets. For me, having a good business, investing in a good business that you can directly affect through your actions, through finding a predictable formula to make money. Sometimes it takes you 6 months. Sometimes it takes you 3 months. Sometimes it takes you 2 years, to depend on how big your dream is, to figure out the formula. So, hey, I do this on Mondays. Hey, I do this on Tuesdays. Hey, I do this on Wednesdays. I'm making money.
Right.
I need to make a little bit of money. I got a double time on Tuesday. We're going to pull an all-nighter on Wednesday. Okay? And the reason why I say business is I want to protect the jobs. Protect the jobs. Let's have the jobs. But sometimes your ability, your control over your liquidity is outside of your job. You can't determine how much you get paid. You can't determine how many hours they pay you. You have very little agency over that. But what you do have agency over is this business. Once you figure out, first you got to make a plan to figure out how to come up with a formula for success. It takes a minute. You decide what you want to do, then you got to figure out the formula on what you do on every day of the week, every day of the money processes. This is why I always, especially for those of you, I understand macro, but the thing that I understand better is business. This thing right here, they're going to be trying to take me out and put me in the machine. Nicole is a business genius.
Not put you in the machine.
In the robot.
That's what they doing.
That's what I know.
That's a whole nother thing.
That's another conversation. We'll talk about that. Okay? So this is what I want you to think about. All right. Now we got to go into some solutions. I have more stuff that I want to say about this, but now we got to go into some solutions because some of y'all are freaked out about this retirement thing. And I'm telling you right now, private credit affecting the banks, with the Fed coming out saying private credit and NBFIs are affecting the banks. They cannot. We live in a world that is based in debt. And when in debt, when you're dealing with a system in debt, banks have to remain liquid. They don't care about you. They are the first line of defense and the last line of defense. They hold all the power. Let them take their liquidity from somebody else.
I mean, okay, back to my analogies, because like I said, my brain thinks in analogies. The banks are the heart, right? And the blood flow.
I wouldn't say that. I say first and last line of defense. You are the heart and the blood flow.
Well,
you individuals.
I'm only speaking of liquidity. I'm only speaking in terms of liquidity.
No, that's the great trick. We don't need banks to provide liquidity for the world. Now we do because of this debt system. In 2026 we do. But in terms of how, this is just Nicole theism. Nicoleology, Nicole or my economics. Right? I'm going to actually look for a literary agent because I want to write. I have some theories that I want to put on the paper in terms of economics. I'm going to write the next. It's going to be a best-selling economics book. I cannot wait to write this. Okay, so if you know a literary agent, if you are a literary agent, you like this shit, holla at your girl. I want me a nice check though. We're not going to sign nothing until I hit the number, the social media number that will give me a nice check. I want a nice advance. And the book is already up here. I'll get it to you in 6 weeks. Okay? All right. My belief is that markets provide liquidity on their own. Before, we've had history of all different types of economies throughout history. Banks they actually haven't always been there, but versions of banks have been there throughout history. And guess what? They function fine without them. People bought, they sold, they lived, they made babies, they got married.
Right.
People was ugly, some people was fat. Some people had spiritual enlightenment, some people didn't. They lived their best old world lives. And they did business. Here is a fun fact. I don't know if we talked about this on this show. I'm reading a book and no, we didn't talk about this on this show. I think it was Keynes, an economist, who introduced this idea for the purpose of his argument that he was doing in his writings, that human beings historically, from an economic standpoint, the way that they did business is started out with a barter system and then money was introduced. Do you believe this? Like, hey, cavemen bartered and then money came about.
Yeah, I believe that.
Do you know that there's no record in history that shows that barter was the main way of doing business? Human beings have always used money. Always. Which is, I keep telling y'all, money is spiritual. But they've always used money. You know when they use barter? When the money system stopped working. It was always a number two. They do not have history. I know you don't believe me.
No, it's not that I don't believe you. I'm just trying to think because of like what could have been the currency, you know?
So I'll give you an example. So, you know, in Africa, they use cowrie shells, metal, paper. This is not the first time that paper has been used as money, but I'll give you an example. They looked at some island, I think in the Pacific, and they realized this was crazy. They had these big rocks, and the rocks was currency. You couldn't even move the rocks. And the ownership was like, okay, so let's say this rock is, let's say this is a rock, right? And me and you do business. This rock does not move from right here. It's big. Nobody can move it. Hey, I want to buy that hat off of you. This is my rock though. Even the rock might be across town. Hey, the rock over there on 123 Main Street, that's my rock. I want to buy that hat. Hey, I'm gonna give you the rock. The rock don't move. It's like a ledger. They have recorded that one time they was transporting one of the rock by boat. The rock fell into the ocean and the rocks never left the currency system.
What?
Yeah, I know.
What?
I know. So this is what be tripping me out about the way that they tried to portray human history. Like we was completely stupid just that many hundreds of years ago or thousands of years ago. Like we was just dumb. It don't take a rocket science to figure like, let's just use this. Lip glosses. Y'all know how I am by my lip glosses. Lip glosses will be the new. This is not a novel genius concept.
It's not. I would agree with that. Yeah, it's not.
And they want you to believe that somebody. I'm trying to censor what I'm saying in my head. Somebody came up with that thing. Oh, here's money. And this was just 200 years ago. This was just 500 years ago.
Well, correct me if I'm wrong, but biblically it's just always been gold, no?
No, silver. Remember? Judas traded. Joseph got sold for 30 pieces of silver.
Well, not traded, but what I'm saying is, as far as creating a sense of earthly value, something has value.
Silver has been. I just told you that Joseph got traded for 30 pieces of silver. Jesus was sold for 30 pieces of silver. Well, I guess your question, what you're asking me is, typically throughout history, gold has been the most valuable metal.
Right.
I can't say 100% yes from me doing history research, but yes, Nicole, off the top of her head, yes, that's been a very valuable metal throughout cultures and throughout history and throughout time. But not the only value, because when you look at some of the Roman coins, I think it was some mixture of copper and something else. So not the only metal of value throughout history. Again, paper, this is not the first time that paper money has been a thing. I think in ancient China, they had paper money. Okay, we could do a whole, if y'all want to do a episode about the history of money. I don't know how I try to make things, I try to do episodes that you can take advantage of. That would just be like a fun fact type of thing. Like, here's the history of money. I don't know what you would, I will tell you what you can get out of it is help you to understand that it's spiritual and stop falling in love with the physicality of it.
Great segue into what I was just about to say, because I just found a verse that really just tied it all together. Proverbs chapter 3, verse 13 through 15. Blessed is the one who finds wisdom, for her profit is better than the profit of silver, and her gain is better than gold. She is more precious than jewels, and nothing you desire can compare with her. I just think it's crazy how it says the profit is better profit than silver, better gain than gold.
Yeah, we'll have to look up to understand. I will look at the original translations of the text to understand. And then you have to look at the history in that time of why profit is associated with silver and gain associated with gold. Probably because liquidity silver is associated with liquidity and gold is associated with wealth. That's off the top of my head how I would. But I need to look at the translation, because sometimes you look at the translation and the original word don't even mean that. It's like, y'all did the best y'all could.
Yeah. Homework.
Okay, cool. Now let's talk about what you can do about it.
All right, so yeah, I got a question. You know, we always drop our question in the comments for them to answer and come up with. You were talking about formulas earlier, but you were telling people to create a formula for liquidity. Like,
that's funny. That's going to be the first thing. What you people can do about it. First things first is create a benchmark for your personal liquidity and how you're going to determine it. Let me explain. For risk, they have a bunch of models, mathematical models for managing and measuring risk. We can talk about that another day. That's for you math nerds. If you want to hear about it, I'm a math nerd. I had AP calculus in high school, okay? Then got to college and did statistics 75, whatever it is. Like, I am a 100% math nerd. If y'all want me to break down some financial numerical models, mathematical models for risk, I can. I love doing this because most people don't understand. Like, even when we talk about diversification, you can diversify some of your risk away. You can pass some of your risk on. You can diversify some of your risk away within your portfolio just through basic diversification. That's a way you can do it, and it can be measured. You can do it mathematically, okay? But liquidity, the measurements for measuring liquidity are going to be different from institution to person, and they are not widely as accepted. And so I came up with a couple. We only have enough time for me to share one. If you are in the Profit Door, our Profit Door community, I'm going to share some other ways that you can measure, but I'm going to share one that you can adopt, or you can come up with your own way. Totally up to you. Okay. This is a personal liquidity ratio. If you take all of your liquid assets and divide it by your monthly expenses, it's going to give you a ratio. You want me to tell you, hey, should it be greater than 1? Should it be this? I can't tell you. It's a benchmark for you and your comfortability. And what are your liquid assets? Real estate is not liquid. Your cash, your money market account, your treasuries, your savings, the savings that's not in your retirement account. Your retirement assets, not very liquid. So I'm sorry, even if you got treasuries in your retirement assets, can't really count that because you can't get that access to that cash. Now, if you say, hey, I don't care and I'll take the penalty and I want to count it, I'm not going, whatever, do your thing.
yeah.
But this is your benchmark, how you feel comfortable. And the whole point is to look at this number and say, am I comfortable? Do I feel comfortable? Before you even look at the number, do I feel comfortable with my liquidity? Okay. How much liquidity do I have in relationship to my monthly expenses? Is it a certain amount of month? It is a certain amount of year? Or a certain number of years? Where do you feel comfortable? And if you are not there, then you need to set and prioritize a target. Does this mean selling off some of your illiquid asset and put it into your liquid assets? I am not saying that. What I am saying is focus on getting more liquid through your day-to-day business. Remember, speed of money, speed of money, speed of money, speed of money. How can you grow your business? How can you increase the amount, how quickly you get paid and turn that money over? And I keep saying business because that's the way that you have the most direct agency over that number. You can do but so much. Shout out to all you nurses. I always say nurses make the best investors because they have so much agency over how much money they make. There's always unlimited overtime, and y'all overtime is crazy, and y'all get paid a crazy high number. And y'all are so trained and disciplined, and you have to be disciplined in what you do, that it translates into all other areas. Investing. So even you nurses who have the most agency over how much money you make, you're still capped. You can't work more than 60 hours a week. You can't work more than 80. There's but so much you could do.
Yeah.
They're going to tell you, sit down, sis, or sit down, bro. Go home. You're tired.
Yeah.
You gave Miss Jones, Mr. Smith's medicine. You're gonna get us all in trouble. Okay, you're tired. We can't do it. Okay. So this is why I say doing business or partnering in someone else's business is the best way to have unlimited agency and have unlimited liquidity potential. Depends on the business that you're in. But that's a whole nother conversation. This is why I say I'm good at it, because that's a whole nother teaching. Do y'all want me to teach it? Let me know. I don't know if I'm gonna want to.
I want you to teach it. I want you to
It's
teach
not
it.
macro. It's business stuff. And y'all gotta be cool with that. Y'all gotta still show up and
not
send it
macro,
out.
but it's good meat. It's good meat and potatoes.
It is good meat and potatoes. If I do it, y'all gotta make sure that y'all send it out to 5 people just to show the algorithm that this is being shared. So the algorithm's like, okay.
And then for the new people, because you said it so briefly, so casually, but you got consistent watchers and then you got new watchers. So you spoke about the profit door.
The profit door. Thank you so much, Brandon. You're the best. The profit door is our private investor network. I don't want to say our community. That's the best way I can describe it, but it's not that. It's a system. And it's not just a course. It is a system. When you join, you get access to an insane amount of library of content. Specifically, the one that is my pride and joy. Two courses. This is the best way I can describe it within the community. It's actually 3. You get access to about 10 to 15, all right? Some are going to be for you, some of them are not. But for the most part, most of them are for all of you, right? But the 3, that's my biggest pride and joy. The first one is my God, Goals, and Money framework. It is the framework. You can know all this stuff, and that's another reason why a lot of you haven't gotten to the success goals that you want to get to, because you keep putting good seed in not so nutrient dense soil. Your mind has to be right. I don't care how good this information is. If your mind is not nutrient dense enough to grow the seed into what it's supposed to have so it can produce fruit, don't matter how good the seed is. Think about the incorruptible seed, the word of God. The word of God is good. When you see it not working on somebody, it's because the soil is not good. And so that course is a 47 module course. My pride and joy. I want all of y'all to take it. And it's based in biblical principles. It is hot fire flames. One of our members just said the other day on our training, she was like, I had to go through it. They all, when everybody comes in, they're blown away by that. Okay, so you get access to that. Then you get access to our 1% Beginners Boot Camp. That really breaks down how to structure a lot of this stuff. Also, too, I want to say this one other thing. In God, Goals, and Money, there's a module, the business portion. Remember, I told you that's really where I'm really good at. There's a business portion that like literally helps you map out how to do your business, how to set it up, how to get to those predictable profits. And then the other course is the apartment investing course. And there's a 4th one too. There's apartment investing course, and then there's one for single family real estate investing in there as well. And apartment investing has 26 modules. Single family real estate has 47. And then the single family real estate 47, they're all like an hour, 2 hours long. So you literally just take your time, go through. You don't even need a mentor. I'm here. I'm your girl. I got it for you. Okay. The link will be down below to join.
That made me think about the names that we've been trying to come up with you. Or that made me think about the names we've been trying to come up with for you.
The last one that we came up with is your personal economist. Your personal financial economist. I think that was what we called it. What's the one that you want to do? You don't even think
I don't know, but I'm gonna shock you with this one. It's just very simple, and it's just a disciple. It's really what it is.
No, prophet. My gift is not discipleship. It's prophet. My gift is prophetic.
Well, when I say a disciple has a command to actually lead somebody to the way, to the truth. Yours is, I don't know if it was intentional, but yours is unintentionally leading people to the way too, but also leading them because that way is to ultimately lead you into a world of freedom. Yeah, freed from bondage.
Well, so let me just be very clear. We have a lot of members that are not Christian that go through God, Goals, and Money because it's not my ministry to be a missionary.
Right.
I love the fact that we have other saints who are missionaries in our way. I love that for them. That's not I'm not going to argue with you about being a Christian. You don't want to do it? And I'm not going to sit here and lay out the proof for you. That's just not my mission. My mission is to use biblical principles so those
principles work, though. That's
what
I was saying.
Whether you're a Christian or not.
Whether you're a Christian or not.
And some people go and double down. I'm like, oh shoot, I didn't know this was in the Bible.
Even the pastors preach that the principles work. The atheists use the principles. The business people use the principles, and the principles work regardless.
I know.
So you're just using the principles. You know the principles. You wrote the principles. You apply them, and you help people apply the principles.
Facts. Okay. All right, let's move on to the next thing that you can do about this. Real quick, like I said, that's one formula that I gave you. Your personal liquidity ratio, all of your liquid assets divided by your monthly bare bones and expenses, okay? And then you decide what's good number. You set a goal to get to where you need to get to, okay? Are we saying sell assets to put up in that top column? No. What we are saying is, or some of you may want to do it. That's cool. Because I still remember, illiquid assets typically pay a higher ROI on the scale. It's a scale, right? Liquid assets pay lower ROI. I still want you to get a good return on your money. So if you have an illiquid asset that's paying you a high return, I'm not suggesting that you go sell it. What I am suggesting is there are other ways to get liquidity other than selling it. The speed of your money, okay? All right. Members, y'all going to get other formulas in our school community, okay? And for those of you, some of y'all be saying school community, and I'll go and search the school community and you're asked to join. No, you have to actually purchase on our website, and then we give you access to the school community. You can't purchase your way in from school community, okay? Just want y'all to know that. Okay, the second thing you need to do is understand the difference between liquidity and valuation, all right? I hope that I painted that picture, and then understand that valuation, it can be mark to market or mark to model. Liquidity is different, all right? Sometimes we think about valuation and equate it to liquidity. It's not the same. Understand that. You can have a high value, be very illiquid, like real estate. The next thing to do is to reduce your reliance on one system. Another way to say this is you need to have multiple streams of income. I don't like saying it that way because there's a number of reasons why I don't like saying it that way. Most people think that means you got to have your hand in a bunch of pots. What you can do is have your hand in one pot and diversify the ways in which you make money or build wealth with that thing. Okay? I'll give you an example. If you decide that you want to do real estate, let's say you say, hey, I need income, I need to build wealth, and I need to, just say have some liquid assets just sitting. And what most people will do is, I got a job over here and I'm a phlebotomist. And then I'm over here, I own part of my cousin's business, which is we sell Chinese food, soul food, Chinese food. And then over here, I trying to buy this duplex. And I'm not saying that's a bad way to do it, but I'm going to tell you what's an easier way to do it. This is why I don't like saying multiple streams of income, because it can be misleading. You want to reduce your reliance on one system. If you're going to do real estate, how can you have different types of income and wealth building within that? So what a lot of people typically do is, hey, I'm in real estate. I buy and sell property. I'm also an agent. I'm also a property manager. So you're in the same industry.
Yeah.
But you've figured out how to monetize it different ways. If you're a property manager, if you're getting busy, you're taking on a lot of properties. One of our members, she's a property manager and an LP and a real estate investor. Guess what? She's picking up a whole giant portfolio of properties. She about to have triple digits doors under management. Guess what? That's cash.
So you saying essentially just pick your market and scale it.
It's a strategy. You don't have to. This is what I like to do. Because once you have all these different things, that's different logos, that's different communities, that's different networks, that's different people you got to know. That's stressful. You got to keep in mind, it's not just about time, it's about your capacity, what you can remember, what you can have on your mind. When you got to worry about the cook over here from the Chinese restaurant, he fighting with his baby mom She bust out the window at the restaurants. Then you got
Not at the Chinese soul food
the
restaurant.
Chinese soul food or the Korean Mexican restaurant, whatever you want to do, right?
Yeah.
Y'all know y'all love a fusion restaurant, but then at the same time, you know, little John John's baby mom busts out your window, but at the same time, your coworker at the hospital, she mean it evil and vindictive. So you got to come into work thinking about her. Oh, and they want to take my hours away. John baby mom stressing me out to get a phone. They taking my hours away. Honey, you just got a review from work and they telling you, you know, you didn't get your salary bump. Oh, and that property that you're trying to close on, oh, guess what? It didn't pass inspection. Or the appraisal, it came back bad. So they're not going to preview for the loan. This is too much.
Yeah.
This is how y'all be getting burned out. But guess what? If you got it all in one house, it's just nice and neat and easy. Guess what? You're an agent. You sell the property to a landlord. Hey, also I'm a property manager. You need a property manager? Oh, 2 years. You want to sell it? I'm an investor. I've managed this property.
All things real estate.
How you want to do it? I'm not just saying that. I'm just saying figure out. It's called a flywheel.
Yeah.
It's called a flywheel. I am a big proponent of a flywheel. Okay? So stop. Figure out how you can not rely on one system. Is your retirement just your 401k? This is another way to think about it. Is your retirement just your 401k? Are you also investing outside of your retirement for some stuff for that rainy day? Because we don't know what they're about to do. If it's all up in AI.
Yeah.
Y'all, they keep saying that AI look like right now everything with AI look like 1999, which I told y'all before anyway. It been look like 1999 because y'all doing dumb stuff with it the same way we was doing dumb stuff with the internet.
They saying AI look like 1999, but
they're just now saying it. I've been saying it to y'all.
But you know how I feel. You know, I think 1999 had its thing where, like, all things come to a peak, and when they come to a peak, you either stop momentum or momentum drops, or either you just kind of float around. I don't think AI has peaked yet. I don't see it. I don't think AI has peaked at all yet. If that makes sense.
The .com didn't. You're thinking about peak the wrong way. What do you mean by peak in terms of how much cash inflows, or do you mean how much profits? Because that was the problem with the AI, the tech bubble in 2000s. They weren't making any money, but the valuations was out of control. Same thing here. Y'all not making no money. These valuations is out of control.
And my thing is, AI doesn't really have to make money if it can if it can cut expense, if that makes sense.
No, it doesn't, and I don't want to argue with that because you're wrong. It has to make money.
Well, if
it can cut expense, bro, they're not thinking about cutting expenses. It's not even possible. Three prompts from chat cost 3 bottles of water. What you talking about?
How much does one person cost? One person costs $80,000 to $100,000 a year. I'm talking about an employee.
But we're generating. I don't want to talk about this right now. The other thing I want you to do, specifically with your retirement accounts, I want you to pay attention to your fee structures. There is a whole big thing about fees that I could go into. Shout out to my really good friend who his whole platform, soapbox that he's been on, is all about teaching people how to look at their fees, irregardless of CITs. Teaching people how to look at their fees in their retirement account. Sometimes people are getting beat in the head over fees. And if you just take a little bit more agency, control over what's in your retirement account, even based on the menu that your job gives you, you can get a better return just by looking at the fees. So like, let's say the fees are X amount. If you're keeping it in something super safe, that thing may not outperform the fees. And so you may have to really think about how to look at some of the other investments so that you can increase the return to outperform the fees. Now, the other thing I want you to look about is with fees is the reason why CITs got popular is because they have low fees. So if you're going to decide to get out of your CIT because you're not comfortable, Nicole is not recommending you get out of your CIT. If you decide that you want to do that, know that the alternative may be something with higher fees, so you need to look into it. Okay. The other thing I want you to understand is that tax or retirement account are legal tax structures. They're just legal tax structures. They're the type of thing, and then inside of it, depending on the type of account you have, it has different vehicles in it. Understand the structure. A lot of people don't. Some of you who do are like, yes, Nicole, that makes sense. Some people don't. Okay? So what I want you to look at is what's in it, who's managing it, how transparent it is, what have the returns have been, and you should look at all of it. Also want you to look at how it's valued and what risks it carries.
What are the boulders in it?
What are the boulders, and whether you done took on a boulder or not.
Whether you done took on a boulder and don't even know it.
Don't even know it. The last thing I want you to do with your retirement is I want you to take on an investor mindset and not a passive saver mindset. You don't, do you got to like quit your job so you can actively manage your retirement? No, but it does require some decision making. This is why you are here. Put this to use. For those of you who are a little bit scared of like going out and investing and pulling some of these big trigger investments, the strategies that I'm saying, that's okay. Start with your retirement account. Look at it, see what's going on, understand it, ask questions. Do as much research as you can before, if you plan to pull any triggers. It's your money. You can ask questions. You can just ask questions and let it sit.
I would be
And max that thing out.
go down a rabbit hole of the boulder. It's like footprints. Like they always say, follow the money. Because if you find the boulder, then you'll be able to track where it came from. And
If you see some of the, we've been talking, there's some boulders that you're not going to be aware of.
Yeah.
Right?
True.
Because you can't predict everything.
Right.
But we've been specifically talking about this private credit risk thing. That's the boulder that you're going to be looking for right now. And illiquidity. Because illiquidity is not just a private credit issue. The illiquidity is a bank issue. The illiquidity, we didn't even, I had in my notes, we didn't even talk about like the Treasury is very aware that there is a bank illiquidity could be an issue. We talked about this in the past. I don't want to, all right, what I really want you to understand, I'm going to reiterate this last thing. Insurance companies are still the best absorber for the private credit risk. But I want you to keep in mind that CITs are a back door, and your retirement, your 401k could potentially have CITs in them. And thus, like I said, could be a ticking time bomb. Because if the banks are telling each other that this private credit risk has spread to banks, like I don't think y'all understand. I really hope y'all understand how big that is. And I hate the fact that the news is not covering it, but I love it because it's giving me fodder. Right? It's giving me something to put y'all up on game about. That's a big deal. Because theoretically, all of them banks that said, especially Jamie Dimon, he got on that earnings call and said, this has not spread. Look at the numbers. And the New York Fed said, it has shown cracks in the system. The banks, when we looked, the ones that had NBFIs on their balance sheet, those were the ones that performed worse. And I'm telling you right now, don't you ever forget this. In this debt system that we have, it's a global debt system. Banks will always be more important than anybody. So you make sure you stay liquid. Build that business. Turn that money over. This is the time. This is not the time to ball out. Yo, if you see somebody flexing on some spending money stuff, unless you know they just like filthy rich, like disrespectful, filthy Elon Musk rich. I ain't talking about somebody that's got like a little, 6 figures, even 7 figures. unless you 8 figures, 9 figures in a year in income, and they flexing. Corny. Just put a corny. Corny. Because one, you don't know what you're doing. This is not the time. When you see people being frugal, like my mom was like, I FaceTime my mom every day, y'all. And she's like, oh, I love that dress. That's new. No.
No.
I done made content in this dress about 3-4 times over the last couple of years. The level in which I'm being frugal right now.
So frugal. They don't even know your toes done today. And I walked in and
I got my nails because my birthday is tomorrow.
toes done, nails done.
Toes and nails. We're doing a spa day with my girlfriends, and I feel like it's gonna be some pictures
Not
with
you
some toes
spending
and
money.
some nails. I know. Yo, I'm loving my frugal lifestyle. I love it here. Cause guess what? All my money is going into building this, and it's paying off. It's paying off so well because everybody else want to show how they not getting hit by this. Psh, come on now. Come on. You're tripping. Who cares?
The more money I make, the less my t-shirts got stuff on them.
That part. People who got stuff on their stuff, put a corn. Put a corn and tag me. They don't. Maybe don't put a corn. Put a peach.
A peach?
No, maybe. Oh, I'm thinking.
Wait,
no,
give me
a stupid.
Let me look at my emoji list.
I'm sorry, I didn't mean to say peach.
Not a peach. You know they gonna put a lot of peaches on it. They gonna peach you, all right.
I was gonna say cherries, but then that could go somewhere else too.
Lord. Just put like that X emoji.
No, not an X. It's got to be real, like benign.
That X.
I don't want to be mean, but it's funny.
What about the Z's? Sleep.
No,
You don't like
it's
to
got to
sleep?
be in a way that they don't
You don't
know
like
what
to
you
sleep?
put in.
Okay, hold on.
Like a phone or something, or a computer, a saxophone. Put a saxophone.
A saxophone.
Just so we can remind them. They don't care about you. Stop putting this. You got to get your stuff, get your ducks in a row. And shout out to everybody.
What about a pig? You just put a pig.
No, that's
You don't like a
mean.
pig?
That's mean.
A pig is mean?
Yes.
Lord, how's
you
a
being
pig
greedy.
mean?
Then while he figures out what emoji we gonna do, I just wanted to say shout out to all the people who rebuilding, especially for those of us 30, 40, 50, 60 and up who are rebuilding. Shout out to you. Like
crab?
for real. It's okay. No, you keep picking mean stuff. A crab.
What does a crab mean?
A crab is like an insult. Like you crab. A-N.
Corny's not an insult?
Yeah, that's why we're not putting corny. We're going to find something real benign. Something like a ladybug. Yes, a ladybug. There it is.
A mushroom.
I like a mushroom.
You like a mushroom?
All right, let's do mushroom.
Put a mushroom.
Okay, shout out to everybody that's rebuilding. And you got to start over because you've been in this game for a minute. And you just got to get it right one more time. That's it. Don't give up. You are not alone. You are not alone. All right. I love y'all.